Okay, so this is treasury stock, and we'll be doing the accounting for treasury stock. I'm using the example that's in the notes, so you might want to follow along with that. Carter Company, or Corp, buys back 1,000 shares of its own stock for $50 a share. So when that happens, say that's on, 110, they do that, they would debit the account treasury stock. And treasury stock is a stockholders' equity account. It goes in the stockholders' equity section. And we would credit cash. And how much? Well, it would be the 1,000 shares times the $50 that we paid. Okay, so we would have treasury stock on our books for $50,000. Okay, so maybe in May we decide to reissue or sell some of this back on the open market. So let's say we reissued a couple of hundred shares at $60 a share. So if we reissue them at $60 a share, why don't I just change and use the dates that I'm using on my example? I've got 9/1. On 9/5 we reissue some. And so we would get cash. And how much cash would we get? Well, if it's $60 a share, and it was 200 shares, we would go 60 times the 200 shares and get $12,000. Okay? Now, we've sold some treasury stock or reissued it onto the market, so that means it's not on our books anymore, so we take it off the books. And it comes off the books at the price per share that we initially paid for it when we bought it back. So this is going to come off the books at 200 times the $50. Okay, so that would be 10,000. We obviously have 2,000 hanging around here, and we're going to call that paid-in capital treasury stock. And this paid-in capital treasury stock account gets reported right after with the rest of the paid-in capital for common and preferred stock. But we'll see more about that later. Okay, so that's what's happened so far. So now let's see what happens on the 9th or the 6th when Carter reissues 200 more shares, but only at $45 a share. So we're at September 6th. We know we're going to get cash. And how much cash do we get? Well, we reissued 200 shares, and we only got $45 a share. Okay, so that would come out at 9,000. Our treasury stock, I'm going to abbreviate here, is coming off the books at 200 times the $50 that we paid for it. And so that comes out at 10,000. And this means we have a $1,000 difference here, and we are going to be debiting the paid-in capital treasury stock because there is a reduction. So that's how that is handled. But then on the 9th, or the 8th, we reissue some more. And this time the market's really dropped and we're only getting $40 a share. So we're going to get the 200 shares times 40. And so we're only getting 8,000. The treasury stock, I'll plan ahead this time, the treasury stock still comes off the books at the 200 times what we paid for it originally, or 10,000. And now here's where it gets tricky. We only have, if we think about our paid-in capital treasury stock account, is that paid-in capital treasury stock? We put in 2,000 as a result of the 9/5 entry, and then we used up 1,000 of that when on 9/6. So now we've only got 1,000 left in there to take out, and this account, one of the rules is that this account cannot go below 0. So we can only go paid-in capital. We can only go paid-in capital treasury stock 1,000. Because that's all that's in that account. And for the other we have to go, for the rest, we have to go to the retained earnings account. So when we get to the rules of treasury stock, and sometimes I think it makes a little bit more sense to wait until we're actually doing the journal entries to do the rules. The rules are, basically, treasury stock is not an asset. I mentioned that. It's not an asset. It is a stockholder's equity account. Let's see. And then the other rule is the paid-in capital treasury stock account cannot go below 0. So that's one of the rules regarding treasury stock. So when we get to a point where we would have to debit it too many times, then we have to dip into retained earnings. The retained earnings can be reduced by treasury stock transactions, but never increased by them. Okay, and we see that here where when we're doing this particular journal entry, we would have had to go to retained earnings for the other $1,000. So retained earnings can go down as a result of treasury stock transactions, but it can't be increased because any increases are going to be showing up in the paid-in capital treasury stock account. Which brings me to the other obvious rule here, where there are no gains or losses recognized on treasury stock transactions. No gains or losses. All increases and decreases, which are kind of like gains and losses, show up in the paid-in capital treasury stock account. Okay? So if you think about it, step away from it for a minute. You bought some stock at $50 a share. Okay? So just say you bought a stock at $50 a share. And then when you sell the stock, you got 60. That means you've made 10 bucks. You're 10 bucks better off as a result of selling it at 60. And so that's why that increases our additional, our paid-in capital treasury stock. It's making the company better off, but because it's a stockholder transaction, we don't call it a gain or a loss. And it's not counted as a gain or a loss. It does not go on the income statement. It goes right here. Okay? And then if you think about it, you paid 50, and then when you start selling it for 45 and 40, you're not as well off. You're essentially reducing the stockholders' equity section on that. So anyway, those are a couple of things about treasury stock. Let's see. Just seeing if there's anything that I have forgotten to mention to you here, and I think that is about it. One helpful thing I would suggest is when you're doing these problems, do out ledger accounts for each transaction and just physically see how they impact paid-in capital treasury stock and retained earnings. Okay, so that'll be it for treasury stock. I will work through a sample problem in another video.